Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news to highlight. Investors have cheered moderating inflation numbers lately and the pause in interest rate hikes that have come with it. Here we see a CPI inflation consumer price index down from 9% peak last year down to about 4% recently. And even with the profit taking last week, the S&P 500 is now up 13% for the year, has crossed into that bull market territory. But the easiest drop in inflation may be over, and analysts at UBS Wealth Management believe we could be entering a new wave for higher prices. So the question is, will that new wave of inflation derail the bull market, and how should you be investing? We're going to cover that. Stick around after that. We'll have our Monday market update, all the stocks to watch this week, and the economic news to guide you. First, though, huge announcement to make. It's been 2 years in planning, but I'm finally ready to announce your opportunity to get a share of the revenue generated by this channel, the Let's Talk Money channel on YouTube. I love the Let's Talk Money community we've built and want to offer you a chance to be a partner in it. Through an SEC registered crowdfunding offer, for the first time ever, I'm offering revenue share securities in this Let's Talk Money channel. Through Gigastar Markets platform, I'm selling revenue share units, securities that will each month distribute a percentage of the revenue generated by the channel to you as investors. That revenue was $115,000 last year. It's been as high as $28,000 a month back during the pandemic. Regulations by the Securities and Exchange Commission do prohibit detailing the terms in a semi-public forum like this, but I can link to the offer page in the description below, as well as a Q&A section to answer all your questions. What I can tell you is this is open to all investors with shares starting at $31 each. You're going to get monthly income with the potential for growth as this channel grows. You're also going to become a part of the investor community and get special perks like investor-only live streams and stock alerts. That public offer of shares starts Tuesday, June 27th at 3 p.m. Eastern. I wanted to give you advance notice before the launch though, so you can check that out. Get ready for this because previous offers have sold out in less than an hour. So I wanted to give you advance notice. Check out the link to Gigastar Markets in the description below and look for that tomorrow, Tuesday, June 27th at 3 p.m. Eastern. I want to get back to our main topic though, because you can see here in the consumer price index, although inflation has come down from surging to a 9% annual pace last year to just 4.1% last month, it is still double the Fed's target of 2% and could be coming into that new wave of price increases. Of course, that could force the Fed to raise interest rates once again, disappointing investors and really taking back some of the gains from this year. That's from analysis by UBS Global Wealth Management, which says the U.S. consumer price increases have really been forced higher by a series of waves rather than just one singular force. Okay, those inflation waves have come one after another, making it look like a continuous movement in prices. And now a third wave is coming that could surprise everyone. The first wave of inflation was really from consumer durable goods, right? The rapid increase in buying of those long-lasting consumer products like appliances and cars during the pandemic. The lockdown consumers weren't spending on services, which is usually a big chunk of their budget. They were spending instead all that stimulus money on these big ticket items, these durable goods, which drove those prices higher. The second wave then was supply-driven inflation from multiple events. The pandemic broke supply chains across the world as companies really struggled to get their goods from factory to consumers. So that combined with the invasion of Ukraine, which caused oil prices and energy prices to surge, really led to that second wave of inflation. And it's the combination of those first two waves that really pushed prices skyward to inflation of multi-decades highs at 9% last year, but both are largely fading right now. The third wave of inflation, though, the one keeping inflation stubbornly high this year, is what UBS here is calling greedflation. So this greedflation, this always follows a period of inflation before it, okay? In this case, these two waves of inflation, companies now realize that consumers have accepted the price increases, has accepted that inflation is just a part of life now. Companies can then justify further price increases, this greedflation, even as their own cost inflation is slowing. Okay, so in those two previous waves of inflation, we did see cost inflation to corporations. Their costs were going up to source and produce these products, especially through the supply chain, and so they had to raise their prices to pass some of those costs on to consumers. Those costs are now coming down, but corporations are still raising their own prices. So without any pushback from consumers, because consumers have now accepted that inflation, again, is just a part of life. Okay, consumers have become something like desensitized to inflation and don't realize that now the biggest factor in those higher prices is just companies trying to increase their margins. And we see proof of this greedflation in comparison of supply chain costs, right? Even as consumer prices have increased 4% pace over the last year, commodity prices have plunged 21% so far this year, according to the World Bank data. that drop in commodity prices. So metals, energy costs, all those coming down 21% should have been hugely deflationary, should have brought overall inflation down. Yet consumer prices keep on going higher. Wage costs continue to be a factor in inflation, but household income just hasn't kept up with that overall inflation. So now it's not just wages that are driving up prices. It is just corporations driving up prices just to boost those margins. In fact, we can see here in data by the Economic Policy Institute that corporate profits have now replaced labor costs as the largest contributor to inflation. We see here this light blue bar. This is the long-term average, 1979 through 2019. Labor costs were 62% as a contributing factor to inflation. 62%, almost two-thirds of inflation was due to labor costs. That is now completely reversed. Corporate profits up from 11% contributing factor up to 54% right now. Labor costs account for just 8% of inflation right now. Now, of course, I'm not saying this to rage against the corporations, right? I'm a stock investor, I'm a capitalist, so I'm going to benefit from those higher profit margins. But there are two very important implications to this for the market and for investors. First, if inflation does continue stubbornly high, then we can expect at least one, maybe two more interest rate hikes by the Federal Reserve. We see here the CME Group, the CME Fed Watch tool, which is just a market-based predictions of what the market expects the Fed to do as far as interest rate hikes. And we can scroll down here and see that at one point we were expecting rate cuts here as early as November of this year. We see here in July 26th, the market consensus now is 72% that the Fed will increase interest rates at this July meeting, at this next meeting in July. We can go here to November and see that that would be at a 550, it would be 550 basis points would be the target range on that. We can see that as of November, that is still the market expectation is for the Fed to be at that 525 to 550 basis points for their Fed funds rates. So we are now no longer expecting a Fed cut here in November. We can click out further here to December. Again, it's still stuck at that 525 to 550, 46.7%. A little bit more market consensus that we might get some kind of a cut maybe as soon as December. But right now we're looking at maybe January. By the time January, the first time that the Fed is able to actually cut because of this third wave of inflation, this stubbornly high inflation that we're seeing right now. So another interest rate hike and higher rates for longer would be a disappointment for investors. It would further slow down the economy and could cause stocks to come back down a little bit from this bull market run we're having. The other implication here is that investors may want to position for where companies are able to get those higher prices and the higher profit margins. In a study of BLS data here through May, we see the greatest price increases here in pet products with prices over 10% over the last year. Restaurants also up 8.3%. Personal care products also seeing about 6.8% inflation there over the last year. Also alcohol, groceries, new vehicle prices all holding up very well over this last year for inflation. Those are the companies, those are the products that are being able to get that greed inflation passed through to consumers, raising their prices and raising their profit margins. On the other end of the data here, we do see some companies not being able to raise their own prices and may actually see a drop in margins. We see here the price of airline tickets, even though it doesn't feel like it, has dropped 13% over the last year. Rental cars also down 12%. Used vehicle prices down 4%. Transportation down 2%. IT hardware and services down 1.8%. These are all companies that aren't able to benefit from this wave of greedflation just yet, maybe seeing their profit margins come down. So these are the kind of stocks that you might want to consider avoiding. Now, of those companies benefiting, I think pet products and alcohol is probably the safest plays. Even if we avoid a full-blown recession, a weakening economy could cause consumers to pull back and start fighting some of those price increases. But people generally are more loyal to their furry favorites and their favorite drinks. So look at shares of companies like Chewy, like Constellation Brands, which is going to be reporting its earnings this week, for companies that are going to benefit from this wave of greedflation. I'm going to turn it over to our weekly Monday update. Some of the stocks I'm watching this week: Medical Properties Trust, ticker MPW, is now up 20% from its May lows. Much of that after posting a June investor update that showed a deep valuation discount in these shares. The healthcare REIT is now trading for just 6.6 times its 2023 adjusted funds from operations, that's AFFO, versus a pure average of 16.5 times AFFO, which that is a huge discount. It's about a 60% discount compared to the pure average there. The company has been used recent sales to prepay its debt maturities down through 2024, so this company has no debt due through 2024. Fundamentals for hospital attendants are improving. Shares pay a 14% dividend that is being supported by this year's cash generation and really no longer in danger of being cut in the near term. We talked about Constellation Brands, ticker STZ, as one of the companies maybe benefiting from this wave of greedflation. It's going to be reporting its earnings on Friday and could prove to be another beneficiary of those Bud Light protests through the company's Corona brand. The company is expected to post 8.8% growth in earnings to $11.59 this year. That would be on 6% sales growth to $10 billion, neither of which should be difficult to beat for this company. Shares are not cheap, though, based on historical PE averages, but could still get a good boost if those Corona sales come in higher than expected. It's going to be another quiet week for economic news until Friday's PCE report on inflation. That means, again, it's going to be investor sentiment that really guides the market and provides a clue on whether investors can take this market higher. If the market rallies on Monday or Tuesday off of last week's profit taking, then it could confirm strong investor sentiment and really this new bull market. If, however, that market sell-off accelerates or continues early in the week, then investors should consider maybe hedging their bets until sentiment improves. Friday's report on the personal consumption expenditures, that PCE inflation report, is going to be the most important of the week, with core inflation expected to drop only so slightly to 4.6% year over year versus 4.7% last month. So, unless inflation comes down well below those expectations, well below 4.6% on a year over year basis, it's likely the market's going to take that negatively because it's going to show that inflation is not coming down as fast anymore and not nearly fast enough to avoid another series of rate hikes by the Fed. Check out that link in the description below and become an investor in the Let's Talk Money channel. Monthly income through the revenue from this channel. Or click on the video to the right for the 4 monthly dividend stocks that will pay you every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.